All right, let's talk P&G. They just dropped their latest earnings, and wow, it is a fascinating story. It's really a classic tale of a company fighting a battle on two different fronts. So we're going to break down their Q2 results and figure out what's really going on here.
And you see the core issue right away. I mean, it's a tale of two lines, isn't it? On one side, they beat on earnings per share, which is what you want to see. But then you look over at revenue, and it's a miss. So right off the bat, you know this isn't a simple good quarter or bad quarter story. It's way more complicated than that.
Okay, let's get into the nitty-gritty. The core EPS came in at $1.88. That's 2 cents better than Wall Street was looking for. Nice. But the revenue side missed by about $150 million. And here's the real kicker. Organic sales were totally flat, 0% growth. And you ask, how does that happen? Well, they raised prices by 1%, but their volume, the amount of stuff people are actually buying, dropped by 1%. They canceled each other out. Plain and simple, people are buying less P&G product.
So with a revenue miss and flat sales, you'd think the stock would get hammered, right? Nope. The crazy thing is, the stock actually jumped over 2% in pre-market trading. So what does that tell you? It tells you the market heard the bad news on sales, but decided to focus on something else, that earnings speed. And, more importantly, the story management was
So that's the big question, isn't it? How on earth do you beat your earnings target when your sales aren't growing at all? Well, this is what we call the staples grind. It's this tough, messy, operational fight for every single penny of profit when things are difficult. Let's dig into how they pulled this rabbit out of the hat.
You know, management knew this looked kind of weak, so they came out swinging with their messaging. They basically said, hey, everyone calm down. This isn't a surprise to us. The CFO, Andre Schulten, was really clear. He said they fully expected this to be their softest quarter. They're setting this up as the bottom, with a big comeback plan for the second half of the year. And that message, it was absolutely crucial for keeping investors from panicking.
This right here, this is the scorecard for the margin battle. It's a real tug-of-war. The hero, without a doubt, was productivity savings. I mean, 160 basis points, that's a huge 1.6% boost to margins just from being more efficient. They also got another 50 BPs from pricing. Awesome. But look at the other side. Almost all of that got eaten up by a negative mix, people buying cheaper stuff, plus reinvestments and new tariffs. It was an absolute fight just to stand still on profitability.
Okay, so let's just recap the quarter's headwinds. You had the flat sales driven by that drop in volume, and maybe more worryingly, their biggest market, the US, was actually down 2%. Not great. But, and this is a huge but, there's the pillar of stability, the reason investors don't just run for the hills. P&G is a cash-generating monster. They handed back $4.8 billion to shareholders. That's the kind of thing that makes investors patient, even when sales are soft.
All right, so enough about the past quarter. Let's look forward. After a report like that, everybody's attention immediately snaps to the guidance. And management knew it. They didn't just play defense, they went on offense, talking up this big strategic plan they're calling the reinvention of P&G. This is their pitch for how they're going to speed things up in the back half of the year.
And here it is, the big news. They stuck to their guns. Despite the revenue miss, despite the flat sales, they reiterated they did not change their full-year guidance. Now that is a bold statement. It's management basically saying, we know this quarter looked weak, but trust us, we've got this. The plan is working.
So, what are they actually promising? Well, they're keeping a pretty wide range for both organic sales and EPS growth, anywhere from 0 to plus 4%. That gives them some wiggle room, for sure. But it also means they're on the hook to show some serious improvement from where we are right now. And of course, they're still committed to those rock-solid free cash flow targets.
And this is where the new CEO, Shailesh Jejurikar, really puts his stamp on things. Listen to the language he's using. He's not just talking about navigating a tough patch. He's talking about constructive disruption, about inventing the CPG company of the future. This is the grand vision, the big story they want investors to buy into for the long haul.
So you're probably asking, okay, great vision, but how are you actually going to do it? Well, they've laid out a 4-step playbook they're calling their interventions. Step 1, job 1 is to fix the US business. Step 2, they need to launch bigger and better innovations. Step 3, keep finding those cost savings to pay for all this. And step 4, use all the new tech, data, AI to get an edge. That's the roadmap. Pretty clear.
And all of this really boils down to one simple thing for investors. Management is making a huge bet on themselves, promising a big acceleration in the second half of the year. The question for everyone watching is, can they deliver?
I mean, this really is the multi-billion-dollar question, isn't it? Will this playbook, these interventions, all the new products they have coming, will it be enough to get people buying more stuff and get that sales growth moving in the right direction again? Honestly, the entire bull case for the stock rests on the answer to that question.
So this is the dilemma every investor faces right now. On the one hand, you've got the bull case. They beat on earnings, they're a cash machine, and management is standing by their guidance, super confident. But on the other hand, the bear case is just as compelling. They missed on revenue, sales are flat because volumes are down, and their biggest market is shrinking. You can see why people are divided. Both arguments are really strong.
Okay, so where does that leave us? Let's wrap this all up. It's time for the next call. Our rating on the stock, what we think happens next quarter, and a little trade idea to think about.
We're rating the stock a market perform, and here's why. You simply cannot ignore their operational excellence and that incredible cash flow. Those are top tier. But you can't ignore the sluggish sales and the fact that their big turnaround story is still just a promise. There's real execution risk here. It's the definition of a show-me story. They need to prove it.
So what about next quarter, Q3? Honestly, we're expecting more of the same grind. We wouldn't be surprised to see another small miss on revenue, but they'll probably find a way to squeeze out a small beat on EPS by managing costs. Organic sales should pick up a little bit, mostly because the comparison gets easier. But for the stock price, we think it's going to be stuck in a range until the market sees real, hard evidence that growth is back for good.
Now, before I give you the trade idea, check this out. This is fascinating. Heading into this earnings report, the volume of call options, that's basically bets that the stock will go up, spiked more than 760%. That is a huge amount of speculation, a ton of people betting on a massive breakout, and that sets up a really interesting situation.
Okay, so here's the trade idea. You have the options market priced for an explosion, but the actual company fundamentals suggest it's more of a slow grind. The idea is to bet against that explosive move. You can do this by selling what's called an out-of-the-money call spread. You're basically selling those lottery tickets to the super bullish traders and collecting that juicy premium. The bet is that P&G stock doesn't have a huge surprise breakout and just kind of chops around in that range we talked about. If that happens, volatility drops, time passes, and you get to keep the premium.
And of course, I have to say this, none of this is financial advice. This is just for informational and educational purposes. Always, always do your own homework and talk to a professional before making any investment decisions.